This is an overview of Chapter 6, Intro to Deductions. So deductions are not entitlements. They're a matter of legislative grace. So this just means that you must provide substantiation. So taxpayers have the burden of proof and they must keep adequate records. And this does not just mean you have a credit card that produces a report on where you spent the money. You would have to keep receipts and other documents for business deductions, right? So deductible expenses. So we have above the line deductions and below the line deductions. So remember the tax formula. We're going to start with gross income, which is an inclusion, all-inclusive definition, right? And then we take exclusions, so things that are excluded from tax, right? Then we take above the line deductions, which are called adjustments. And then we get the adjusted gross income, or AGI, the line. This is really important. A lot of credits and other items are related to what is your AGI. So it's an important number. Then the greater of the standardized deduction or itemized deduction, which we're going to talk about. And then qualified business income deduction, or QBI. This is for people who have self-employment income through a pass-through entity or a Schedule C, and then we subtract that and we get taxable income. So this is the 2023 adjustments to income. So educator expense, that is for K through 12 educators who buy supplies. They can take up to $300, and if both people are educators, they each can take $300. Business expenses for reservists, performing artists, and fee-based government officials. Otherwise, business expenses have really gone away. We'll talk about health savings deduction, moving expenses only for armed forces, deductible part of self-employment, self-employed retirement plans, health insurance, penalties paid on withdrawals from savings, alimony paid only for divorces pre-2018, IRA deduction, student loan deduction, Archer medical, jury duty pay, and there's a bunch of other ones. So we'll go over these. An example of an above the line and a below the line deduction. A single taxpayer has a gross income of $50,000. What's the taxpayer's taxable income if they have an $8,000 above the line deduction? Well, they take gross income minus the $8,000 equals AGI of $42,000, and then a standard deduction for 2024 is $14,600, so their taxable income is $27,400. Now, let's just say they have $8,000 of itemized deductions below the line. Well, itemized has to be more than the standard deduction. So they have $8,000 in itemized deductions, but standard is $14,600. So you really don't get anything for that $8,000. You're just going to take the standard. So you would end up with $35,400 in taxable income because the standard was the same on both. A lot of people aren't itemizing, and we'll talk about what counts as itemizing. So for a trade or business, only your net profit after expenses is included in your taxable income. That means that all trade or business expenses, including rental property expenses as well, are above the line deductions. In order for them to be a business expense, it must be ordinary, necessary, and reasonable. The definition of what constitutes is the facts and circumstances surrounding each case. This is why AI in accounting doesn't do a great job, and this is why it's just more difficult to identify, because it's a case-by-case basis. Now, if I'm buying golf supplies and I'm an accountant, not deductible even if I'm meeting clients out, etc., right? Now, what if I'm buying golf supplies and I'm a golf pro? Well, that's a whole different story, right? So there is no one definition of the term trade or business that applies to all situations, and there is no code or regulation that gives a definition of trade or business. It must be a profit motive. To be in a trade or business, you must be trying to make a profit. It is usually necessary to ask following questions about business expenses. What's the particular use of the related item? Was the expenditure incurred with the intent to realize profit from producing income? And was the taxpayer's operation and management of activities extensive enough that they carried out a trade or business? So things that are classified, even if you're doing it in the trade or business, you can't deduct, are charitable contributions and gifts, illegal bribes, kickbacks, and any type of damage like that, and then fines and penalties. The Tax Cuts and Jobs Act has provided a 20% below the line deduction for QBI to pass through entities, including a sole proprietor, in order to try to even out that in the C Corp tax rate, which was lowered to 21% in 2018. So additional expenses for sole proprietors, partners, and more than 2% owners of S Corp is half of self-employment tax, self-employed retirement plan contributions, and self-employed health insurance premiums. We will talk more about some of these in chapters 7 and 17. So, long-term care insurance, LTC, is deductible, right? The insurance is treated as health insurance, therefore self-employed individuals may deduct the cost of long-term care insurance on their self-employed line, whereas everyone else will do it on their Schedule A in medical. So the maximum deduction if you're 40 or less is $470, 41 to 50 is $880, 51 to 60, and it goes up from there. So these are adjusted for inflation, and it's adjusted based on their age, and it would go on the Schedule A. We'll go over the Schedule A later. Let's talk about an HSA. An HSA is a health savings account, right? So most people, a lot of employees will end up with an HSA. The benefits of an HSA are that an HSA is, you can save pre-tax money. If you do it through your employer, you can save on Medicare and Social Security on that pre-tax contribution to your HSA. Your employer can contribute. And you can also, if you didn't max out, you could still maximize your use of the HSA before you go and pay a medical bill with this health savings account. You could put money in and write that off on your taxes. So what do you need to be considered an HSA? An HSA, the health deductible in 2024 must be at least $1,600 for a single individual and $3,200 for a family. The maximum out of pocket, so this is a limit that the insurance company can charge you for the max out of pocket, is $8,050 for a single, $16,100 for a family. The max contribution that you can make to this health savings account is $4,150 for a single and $8,300 for a family. You can make an additional $1,000 catch up on each plan if you're over 55. There are penalties for non-qualified expenses. So I can't use this for Advil or anything like that, but I can use it for prescriptions or co-pays or dental or any of those things. So, and also it's not a use it or lose it like old plans used to be. FSAs, stays with you and can grow tax-free as long as you use the money in this account for qualified medical expenses. If you switch jobs, it goes with you. You own it. So even if your employer contributes to it, that's your money instantly. Who can deduct a contribution to a traditional IRA? So anyone who has earned income can contribute, but they may or may not be able to deduct it. The limitations for deductibility is based on AGI, and these limits only apply if an employee or spouse is covered by an active participation plan. So if you are an active participant in another plan, you can't also go ahead and put into a traditional IRA and deduct it. If you're not an active, there is no AGI limit. You can contribute to an IRA. If you are active, then you get phased out from 77 to 87,000 as a single, and married filing joint is 123 to 143. Now, if one spouse is active and the other is not, One spouse can contribute for the non-active spouse as long as your income does not exceed 230 to 240. Active participant spouse must follow the married filing joint AGI phase out. The IRA limit of contributions for 2024 is $7,000 with $1,000 of catch up for anyone 50 and over. The IRA is 50, the HSA catch up is 55, so they have different ages. So an active participant is someone who is covered by a retirement plan as the qualifying factor for contribution limits. If you are covered, then active participant is interchangeably with the word covered. So if you have a retirement plan, you can't just go ahead and put it in the IRA instead and take a deduction with no AGI limits. Now, Roth IRAs, not everyone can contribute, but that's not exactly true because you can always backdoor a Roth IRA. So, what does this mean? A Roth IRA, you put in post-tax money and it grows tax-free, right? So the longer you put into the Roth IRA, the longer it will grow tax-free. And if you withdraw that money in retirement, you won't pay any taxes on those earnings. So if you are single, the phase out is 146 to 161. If you're married filing joint, 230 to 240. If you're married filing separate, the phase out is 10,000. Now, you can always backdoor a Roth. What that means is put the money into a traditional IRA, do not take the deduction, and instantly convert it to a Roth IRA. And therefore, you have gotten around the phase outs of the contribution. Now, if you have a Roth 401k at your work, that doesn't have income limits, so you should take advantage of that option. So moving expenses, so 2025 is the sunset of the Tax Cuts and Jobs Act. And so before 2018 and after 2025, until we enact another law or extend it or do something different, the moving expenses are not deductible. So in 2024, they are not deductible except for armed forces. But 2025, after 2025, the Tax Cuts and Jobs Act expires, so we don't know what's going to happen. So if you got moving expenses, it would have been pre-2018 deductible for the cost of moving household goods, storage and transit, and travel expenses, one trip. What's not deductible is meals, the expense of buying or selling a home, temporary living expenses, and home hunting expenses. In order for it to be deductible, there was a distance test. You must be at least 50 miles greater. So you go to your old home to your old job. Let's say it was 30 miles. So your new job must be 50 miles greater than that distance, right? So 80 miles. You must also be a full-time employee in 39 weeks out of the 12-month period. And you must be self-employed. You must be there 78 weeks out of a 24-month period after moving. It does not require you to buy a house in your new home. You can rent, right? Moving expenses are not deductible from income and are not deductible unless are not excludable. So if the Tax Cuts and Jobs Act, so if you're a member of the armed forces on active duty, you may be eligible to deduct moving expenses if you're moving stations or something in that realm. So I wouldn't worry too much about that. It depends on when you're going to take the test, whether 2025 will happen or not, right? So the penalty on early withdrawal of savings is deductible. So that is from a CD or something like that. Educator expenses, like I said, it's up to $300 of expenses if you work K through 12. Student loan interest. So you must pay the student loan interest and it must be your loan in order to deduct it. There are AGI limits. We'll talk about that. Alimony paid only if you were divorced before December 31st, 2018. So let's talk about student loan interest. Up to $2,500 may be deductible. The taxpayer must have the primary obligation. So if your parent took out a loan for you, and your parent repaid the loan, then it's deductible. If your parent took out the loan but the student repays, not deductible. If the student took out the loan but the parent pays, not deductible, right? And if the student takes out the loan and the student pays, so you must have the loan obligation in order to be able to deduct the interest. The Secures Act expanded the definition of qualified expenses for 529 plans, right? So this is about student loan interest, but you may be able to take 529 distributions to pay for, we're going to talk about that for expenses, higher ed education expenses or K through 12. Talk a little bit about that. How does the student loan interest phase out? If you're a single and you make between 80 and 95, the amount you can deduct is reduced. If you make more than 95, you can't deduct anything. In Massachusetts, though, there is a deduction, and it's not phased out for student loan interest. Married filing joint, it's 165 to 195, and you get no deduction as married filing separate. As I've said in previous classes, married filing separate is what we call a punishment tax status. You can see that lots of deductions and credits and things going forward, tax rates are higher, so it's like a punishment status. So let's do an alimony deduction example. So there's definitely a bunch of alimony related questions in the CFP exam. So this is a focus on the exam. They definitely had a few questions on here. Willie and May divorced in October 2018. So that's before December. They have been married 15 years and have 2 children, Aaron and Hank. Under the terms of the divorce decree, Willie is required to pay May $2,000 a month in alimony for the next 4 years, $1,500 for the next 2 years, and then $1,000. So this isn't all alimony. It would be allocated to child support if it's reduced when the children turn 18. Will's alimony deduction each month will be $1,000. Even though the divorce decree allocated it as alimony, it is technically child support, the difference, the $1,000, because it's reduced, and after each child turns 18, it's reduced. So it's reduced $500 and then $500. So $1,000 of the $2,000 was considered alimony. So let's talk about deduction rules for businesses. So corporations, it must be ordinary and necessary expenses to be deducted on a corporate return. An S Corp cannot deduct medical insurance premiums or retirement contributions for 2% owners. The partnership's expenses deducted on the information return and cannot deduct medical insurance premiums or retirement plans for the ownership, but you can put it on the 1040 form. And sole proprietors can deduct on Schedule C, but they cannot deduct medical or retirement. It goes on a separate line. So it just can't go on the business return, but there is a personal deduction for that on their 1040. So what does ordinary mean? It must occur in the normal conduct of business. Necessary. It must be one that a prudent business person would incur, right? Do I need a $10,000 meal? Probably not, right? Reasonable. Question of fact and overlaps with ordinary and necessary. Reasonable is with respect to the compensation expense. To be deductible under either 162 or 212, any expense must be ordinary and necessary. For compensation of services to be deducted, it must be reasonable. Reasonableness means not excessive given the circumstances. Although the code refers to reasonableness only in the context of compensation, courts have expanded that to other parts. Let's talk about fringe benefits, common deductions for employees. Employees versus self-employed. It's always controversial. The issue of an employee versus a self-employed status is likely to become more prominent in the future, right? People that drive DoorDash and all of these things, they want to make them employees, but there's been lots of arguments about that. The motivation for the independent contractor status. Businesses are motivated to treat people as independent contractors for several reasons. 1, reduces the cost of employees' fringe benefits like health insurance, retirement, etc. And two, these because you can't provide these on a discriminatory basis, and it's quite costly to pay for health insurance, retirement, etc. And two, it reduces the amount of payroll tax that a company would pay, because a self-employed person has to pay their own self-employment tax, and then they would have to contribute to their own retirement and health plan. So in terms of a service provider, there's advantages and disadvantages of being a self-employed independent contractor. One of the reasons people do want to stay is that you don't have to show up at a specific time. You can DoorDash or Uber drive whenever you want, whatever fits your schedule. You can bring your kids along. I see people DoorDashing with their family, right? But that gives them the flexibility. They might not have in a job, but then they're responsible for all their own expenses, right? So if you want to investigate if you want to deduct investigating a business expense, you must purchase the business in order to qualify for the deduction. Let's just say I go down to Florida and I want to buy a business down there. I need to purchase the business in order for any deduction to going down there and researching it can be deducted. New unrelated business lines, you can deduct up to $5,000 worth of startup costs, and anything beyond $5,000 is you can amortize over 180 months. If it's the same line of business, let's just say I run a manufacturing business and I'm looking at purchasing another manufacturing business in the same line, so I'm going to expand, then I would be able to deduct those as ordinary business expenses, whereas if it's a new line of business, it would be startup cost. The definition of investigation expenses are paid or incurred to determine the feasibility of a new or expanding business. Cost of travel, engineering, architectural surveys, market reports, legal and accounting. Tax issue is whether such expense is deductible and the timing of it. So if a taxpayer is already engaged in a trade or business that is similar, then these expenses are deductible whether or not you acquire the business, because that's just part of doing business. If it's a new business, then you would have to only deduct $5,000 and amortize the rest. If you do not acquire it, the expenses are not deductible and cannot be capitalized because you don't have a business. So, home office expense. This is something that we see more and more. It used to be that employees with a W-2 could deduct a home office expense, but in the Tax Cuts and Jobs Act, that went away in 2018, which is ironic because COVID came right after that and people started working from their homes and they can't deduct any of those expenses if they get a W-2. So a home office expense is classified only for self-employed. If you are self-employed, you get this deduction as a deduction for AGI above the line. It's part of the Schedule C. For an employee, it is gone between 2018 and 2025, but it may come back after 2025. In order to deduct a home office, your expenses are prorated and depreciation is on a 39-year straight line basis. That's depreciation of the home. Now, what else can I deduct? Well, a portion of the real estate taxes, a portion of the mortgage interest, a portion of the insurance, a portion of because if I'm using this and I'm self-employed and I'm working out of my home, then a portion of all of those expenses are allocated to my home office deduction. Exclusivity does not apply for storage and daycare facilities. So you must exclusively use this. So if I have an office, I must only use that as an office. I can't just say my bed is my office. But with a daycare facility, the children come there. And also if you're using something for storage, they don't say you can't store anything else. But if you're using it as an office, it must be exclusive. So also gross income limits apply to this deduction. The allowable home office cannot exceed gross income from the business, less all of business expenses. So you can't create a loss with home office. Any disallowed home office deduction is carried forward into the future. It is reduced gross income first by non-home office and then by home office. So, and then home office would be first your mortgage expenses and real estate taxes, and then repairs, maintenance, and other things. So there is a home office safe harbor election, and the maximum deduction for that is $1,500 based on your space. So what are some tax planning tips? So tax planning tips. The Tax Cuts and Jobs Act suspends the deductibility of expenses subject to a 2% floor, and with the exception of investment interest, from 2018 to 2025. So most employees, all they can do is, most employees with a W-2 can only itemize. So most of the deductions now are for self-employed individuals. Business owners can deduct things that are ordinary, necessary, and reasonable in the operation of a trade or business. Deductions for business owners have no phase out, and they can allocate as many expenses as possible to the business, therefore paying less taxes. Investors, the expenses are directly related to the production of income. Real estate expenses are above the line. So if I have a rental property, which we'll talk about in another chapter, then it's above the line deductions for my rental property. Portfolio expenses, that's about producing income. Investment interest is not subject to the 2% floor. And advisory fees, which you used to be able to deduct, are subject to the 2% floor and therefore suspended from 2018 to 2025. So now you can work on, after watching this video, the online class exercises and multiple choice questions related to chapter 6.